This is Friday, February 20th, 2026. Exactly 22 days ago, silver hit $121.64 per ounce, an all-time high in human history. In the days that followed, it crashed hard, from $121 to $78. Over $43 per ounce wiped out in less than 3 weeks. And while that crash was happening, something else was happening at the same time. Something that nobody in the mainstream financial media is talking about. Because if they talked about it, they would have to explain something that, frankly, they cannot explain. The COMEX, the largest silver futures exchange in the world, just saw its registered deliverable silver inventory fall below 100 million ounces for the first time in years. 100 million ounces. Gone. And at that exact same moment, the outstanding delivery obligations for the March 2026 contract stand at 455 million ounces. If you are watching this right now and you are confused, if you are scared, if you are asking yourself what on earth is going on in the silver market, I need you to stop, take a breath, and watch this entire video, because what I am about to show you does not make any sense. The numbers do not add up. The story the market is telling you is not the real story. Think about what I just told you. The price crashed $43, but the vault it crashed into is almost empty. The paper price collapsed, but the physical metal is being pulled out of storage at 785,000 ounces per day. Let me say that again so it sinks in. 785,000 ounces of silver every single day being drained out of the COMEX registered vault. Not the price going up, the metal itself. Gone. And yet the futures price says silver is worth $78. Does that make sense to you? Does that sound like a real market? Here is what is even more extraordinary. In January 2026 alone, which is not even a major delivery month, 49.4 million ounces of silver were delivered through COMEX. That is 7.27 times higher than the same month in 2024. And in February, with barely a week of data in, the delivery rate is running at 98%. 98% of open contracts are demanding real, physical, hold-it-in-your-hands silver. In a normal futures market, that number is maybe 10 or 15%. When it hits 98%, that is not a futures market anymore. That is a desperate scramble for physical metal. Something is very wrong. And by the end of this video, you will understand exactly what it is. My name is, and if this is your first time here, welcome. I cover the silver and gold markets with a focus on the data that the financial media either cannot understand or is choosing not to show you. If that kind of analysis is useful to you, make sure you subscribe and hit the notification bell, because this is the kind of analysis you will not find anywhere else. A few days ago, I made a video. In that video, I told you that the COMEX delivery system was under extreme stress going into March. I told you that the open interest on the March contract was dangerously high relative to the amount of registered metal available for delivery. I told you to watch the vault numbers very closely. And I was right. But here's what I did not expect. I did not expect the registered inventory to fall below the 100 million ounce threshold this fast. I did not expect the February delivery rate to hit 98%. I did not expect the CME group to raise margin requirements by 60% in a single stroke, which is exactly what they did during the January crash, and for the drainage to continue even after they did that. And I did not expect what I am about to tell you about China, because Beijing just made this situation significantly worse, and most people in the West have absolutely no idea it happened. And that is what we need to talk about. Let me explain how the silver market actually works, because most people do not understand this, and that misunderstanding is costing them money. There are essentially two silver markets operating simultaneously, and they are telling you completely different stories. The first market is the paper market. This is COMEX. This is the Chicago Mercantile Exchange. This is where financial institutions, hedge funds, banks, and speculators trade contracts representing silver. The key word is contracts. Not silver, contracts. Each contract represents 5,000 ounces of silver. On any given day, the total number of outstanding contracts, what is called open interest, represents a theoretical obligation to deliver hundreds of millions of ounces of silver. But here is what you need to understand. Historically, the overwhelming majority of those contracts, somewhere between 85 and 90%, never result in anyone actually demanding physical metal. Most participants just roll their contracts forward, or take a cash settlement, or close out their position. They are not buying silver. They are trading a piece of paper that is linked to silver's price. The paper market is like a giant poker game where everyone at the table has chips, but only a small percentage of the chips actually represent real money that you can withdraw. The casino works fine as long as nobody suddenly decides they want real cash. The second market is the physical market. This is the market where real, tangible, vault-stored, bar-stamped, assay-certified silver changes hands. London, Shanghai, Zurich, the COMEX vaults in New York. And for the last 6 consecutive years, the physical market has been in deficit. Not a small deficit, a structural, persistent, supply cannot meet demand deficit. In 2025, that deficit reached 230 million ounces. The entire world produced less silver than the world consumed, for 6 years straight. And the gap is getting bigger, not smaller. Here is where it gets deeply interesting. When those two markets, the paper casino and the physical reality, begin to diverge, the divergence creates a signal. And right now that signal is screaming. Let me show you the evidence. Pay very close attention to each of these data points because individually they are concerning, but together they tell you something that the mainstream financial world is not prepared to admit yet. Start with COMEX itself. As of this week, the registered silver inventory, the metal that is legally certified and immediately available for physical delivery, stands at approximately 98 million ounces. That sounds like a lot until you understand what it is being measured against. The March 2026 silver contract has an open interest representing 455 million ounces of notional delivery obligation. 98 million ounces available, 455 million ounces demanded on paper. That is a ratio of 4.6 to 1. For every ounce of real silver sitting in those vaults that is available for delivery, there are 4.6 paper contracts claiming the right to that ounce. And if only 25% of those contract holders stand for delivery, a conservative estimate given what February is showing us, COMEX would need to deliver 113 million ounces, more than currently exists in registered inventory. March 1st notice day is February 27th. That is 1 week from now. Let that sink in. But here's where it gets worse. That registered inventory number is not stable. It is falling, fast. In October 2025, COMEX registered silver stood at 167.7 million ounces. Today, it is at 98 million. That is a 38% decline in just over 3 months. And the drainage rate, as I mentioned, is running at 785,000 ounces per day. If that rate continues until February 27th, March 1st notice day, only 85 million ounces may actually be available when delivery season begins. Let that sink in. 85 million available, against potentially over 100 million ounces demanded on day one. Now let me tell you something that was reported just recently that connects to this perfectly. Silver and gold are leaving the United States in enormous volumes right now. Not just leaving COMEX, but leaving the country. Traders and institutions have reportedly been redirecting physical metal from London and other centers toward the United States in anticipation of potential tariffs, and yet simultaneously, COMEX inventory is still falling. When metal is flowing in from London and the vault is still going down, that tells you something profound about the scale of the physical demand that is actually happening beneath the surface. That is not coincidence. That is a structural imbalance in action. Now let me tell you about China. This is perhaps the most important part of this entire video, because while the COMEX drama has been playing out in New York, Beijing has quietly and systematically made the global silver shortage dramatically worse. Effective January 1st, 2026, China implemented a new silver export licensing framework. What this means in plain language is that China, which controls 60 to 70% of the world's refined silver supply, now restricts who can export silver out of the country. Only 44 pre-approved, state-vetted companies are permitted to export silver to the rest of the world through 2027. 44 companies, out of an entire nation that refines 2/3 of global silver supply. The Chinese government officially classified silver as a strategic asset, placing it in the same regulatory category as rare earth elements and tungsten, materials controlled for national security purposes. And in Shanghai, vault inventory has fallen to its lowest level since 2016. Meanwhile, American institutions are scrambling. The U.S. government added silver to its official critical minerals list in November 2025. And just weeks ago, President Trump announced the launch of Project Vault, a strategic minerals stockpile backed by $2 billion in private capital and a $10 billion loan from the Export-Import Bank. You do not launch a $10 billion strategic stockpile for a metal that is plentiful. You launch it because you are terrified of running out. American institutions are now officially treating silver as a strategic military and industrial necessity, while simultaneously the paper futures price on COMEX has been allowed to collapse to $78 an ounce. One side of the government is buying silver in emergency quantities. The other side is presiding over a futures market where the paper price is crashing. Does that make sense to you? That is not a market functioning normally. That is a system under severe internal contradiction. Here's what you need to understand about the industrial demand side of this equation, because this is the layer that most YouTube channels miss entirely. Silver is not just money. Silver is irreplaceable technology. Solar panels require approximately 20 to 30 million ounces of silver per year. Electric vehicles require 15 to 20 million ounces per year. 5G infrastructure, AI data center cooling and circuitry, advanced medical instruments, semiconductor manufacturing. None of these industries has a viable short-term substitute for silver. None of them stop buying when the price goes up, because for them, the cost of silver is a fraction of their total product cost. An EV manufacturer is not going to stop building electric vehicles because silver went from $78 to $100. They will pay whatever is asked because the alternative is halting production. And here is what matters. The industrial buyers are not buying paper contracts on COMEX. They are buying physical metal. They are pulling it out of vaults. They are what is draining those registered inventories every single day. Now let me show you the lease rate data, because this is a technical indicator that professional traders watch and retail investors almost never hear about. Silver lease rates represent the cost to borrow physical silver for a period of time. In a normal, healthy market, lease rates are very low, a fraction of a percent, because there is plenty of silver available and nobody needs to pay a premium to borrow it. In October 2025, lease rates spiked to 40%. 40% annualized cost to borrow silver. That is a panic signal. That is a market screaming that physical silver is extraordinarily scarce and that institutions are paying emergency rates to access it. And it happened during the very same period that COMEX registered inventories were in free fall. When lease rates spike to 40% and inventories are draining at 785,000 ounces per day, that is not coincidence. That is a market breaking under structural stress. Let me connect all of this together for you. What we are witnessing is a three-layer crisis converging at a single moment in time. The first layer is a 6-year structural physical deficit. The world has been consuming more silver than it produces every year since 2019. The cumulative multi-year shortfall now exceeds 678 million ounces, the equivalent of 10 full months of global mine output that simply no longer exists above ground in accessible form. The second layer is the China shock. By restricting silver exports effective January 1st and designating silver a strategic asset, Beijing just removed the largest single source of refined silver from the global market. 60 to 70% of global refined supply is now subject to a 44-company government whitelist. The third layer is the COMEX delivery geometry. March 2026 has an open interest of 455 million ounces. Registered inventory is 98 million and falling. First notice day is February 27th. And February is already delivering at a 98% rate that has never been seen in history. I believe we are approaching the breaking point where one of these layers alone would be concerning. All three arriving simultaneously is something the modern silver market has never faced before. Now let me tell you what this means for you. And I am going to be very direct here, no sugarcoating. If you are already holding physical silver, silver you have in your hands, in a private vault, allocated and segregated in your name, then you are positioned exactly correctly for this environment. Do not be shaken out by the paper price. The paper price dropping from $121 to $78 while the physical vaults simultaneously drain at the fastest rate in recorded COMEX history is not the market telling you silver is worth less. It is the market trying to trick you into selling your physical metal at a discount before the real price discovery begins. Hold. If you are holding paper silver, an ETF, a futures contract, an unallocated account, then you need to understand what risk you are carrying. When a physical default or delivery failure occurs, the exchange has the authority, by its own rules, to force cash settlement at prices it determines. If COMEX cannot deliver physical silver, they do not have to give you silver. They can give you cash at a price they choose and close your position. That is in the rulebook. It happened with LME nickel in 2022. It can happen here. If you are looking to buy and have not yet positioned yourself, understand that the current $78 price may represent the single last discount opportunity before this system forces a repricing. Physical premiums in Asia are already running $10 to $14 above spot price. A 1-ounce silver coin in Dubai this month was selling for $99, while the COMEX paper price was showing $72. That gap is the real market telling you the paper price is a fiction. Some people will say this is conspiracy theory. To those people, I say, look at the evidence. COMEX registered inventory fell 38% in 3 months. That is publicly reported CME warehouse data. February delivered 98% of open interest. That is publicly reported CME delivery data. China restricted silver exports to 44 companies. That is published by China's Ministry of Commerce. Shanghai vault inventory is at its lowest since 2016. That is independently verified. The U.S. government launched a $10 billion strategic minerals stockpile. That was announced by the White House. Silver lease rates hit 40% in October. That is recorded market data. Industrial demand for silver exceeds mine supply for the 6th consecutive year. That is reported by the Silver Institute. That is not conspiracy. That is data. That is facts. That is reality. Let me show you the bigger picture, because what is happening today did not start today. Think of the global silver market like a bathtub. The tap represents mine supply, new silver being added every year. The drain represents industrial and investment demand, silver being consumed, used, and permanently removed. For 6 consecutive years, the drain has been open wider than the tap. The bathtub has been draining. Now, China has not just opened the drain wider, Beijing has put a lock on the tap and said only 44 approved companies can turn it on. At the same time, every solar manufacturer, every EV company, every semiconductor fab, every AI data center builder in the world is demanding more silver, not less. And while all of this is happening, the largest futures exchange in the world is sitting on 98 million ounces of registered metal against 455 million ounces of outstanding delivery obligations, and the clock is ticking toward February 27th. This is not a short-term issue caused by a bad week of trading. This is a structural problem that has been building for 6 years and is now colliding with a deadline that cannot be moved. Now let me tell you what I think happens next. In the very near term, the next 7 to 21 days, all attention will focus on First Notice Day, February 27th, and the opening week of the March delivery period. If even 20 to 25% of March open interest stands for delivery, COMEX faces a delivery shortfall. When that happens, one of 3 things occurs. Either registered silver gets converted from eligible inventory at extraordinary speed and premium, or major contract holders accept cash buyouts at negotiated premiums above spot, which themselves will drive the spot price sharply higher, or the CME group intervenes with emergency rule changes, position limits, or forced cash settlement. All 3 of those outcomes are bullish for the physical price of silver. I'm not saying the Hunt Brothers scenario of 1980 will repeat, where silver ran from $6 to $50 in 12 months, but the fundamental dynamic is the same. A structural shortage, a futures market with more paper promises than physical metal, and forced repricing when the math becomes impossible to ignore. The question is not if, the question is when. And the calendar says when starts on February 27th. Now there are 3 types of people watching this video right now. The first type is scared. They saw silver crash from $121 to $78, and they are wondering if everything they believed about this market was wrong. If that is you, I want you to understand that the price crash and the vault drain happening simultaneously is not a sign that silver is weak. It is a sign that the paper market is doing what paper markets do when they are under stress. They manufacture lower prices to extract physical metal from weaker hands at a discount. The second type is confused. They understand that something is happening, but the mechanics are complicated, and they are not sure what to do with this information. If that is you, the most important thing I can tell you is this. The ratio of paper contracts to deliverable metal is 356 to 1. 356 paper claims for every single physical ounce in those vaults. When confidence in that ratio breaks, the repricing will not be gradual. The third type understands exactly what is happening and has been positioned for this for some time. If that is you, then you already know what the next few weeks may bring. Which type are you? The paper price of silver crashed $43 in 3 weeks. During that same 3 weeks, COMEX registered inventory fell to below 100 million ounces for the first time in years. During that same 3 weeks, China locked down 60 to 70% of global refined silver supply behind a 44-company government whitelist. During that same 3 weeks, the United States government launched a $10 billion emergency strategic minerals stockpile. During that same 3 weeks, February open interest holders demanded delivery at a 98% rate, a number that has never existed in the history of this market. During that same 3 weeks, physical premiums in Asia reached $10 to $14 above the paper spot price. During that same 3 weeks, drainage from COMEX vaults continued at 785,000 ounces per day. One of these things is a lie, and it is not the vault data. It is not the delivery data. It is not the Chinese government's Ministry of Commerce announcement. It is not the White House press release on Project Vault. The lie is the $78 paper price. This is what a managed market narrative looks like from the inside, and the narrative is breaking down. The paper price crashed. The physical metal kept walking out the door. Governments declared it a strategic asset, and the futures market pretended nothing was structurally wrong. That is not a market. That is a magic trick. And now you know how the trick works. If this breakdown of the data was valuable to you, please subscribe and leave a comment below telling me, are you positioned in physical silver, or are you watching from the sidelines? I read every comment, and I will see you in the next video.